Most people think a Fed decision day is just another calendar event, another press conference, another set of headlines, another excuse for the market to twitch for a few hours and then move on. But today doesn't have that energy. Today feels heavier. It feels like one of those moments where everyone is pretending this is business as usual, while quietly checking where the exits are. I'm recording this on Thursday, January 29th, early afternoon New York time, and I want you to actually pause for a second. Notice when you're watching this. Because depending on your time zone, depending on where you sit in the global money chain, the implications of what's unfolding may land very differently for you than they do for someone else. Before we go any further, a quick reality check. The data is brutally consistent. A huge number of people watch these videos every single week and still don't subscribe. If this channel helps you cut through the noise and think more clearly about money, hit subscribe. Not for me, for you. Because what comes next in markets is not going to be intuitive. Now, let's talk about what today is really about. Everyone keeps framing this as a simple question. Cut or hold, as if the Federal Reserve is choosing between two neat buttons on a control panel. But that's not what's happening. What's happening is that the Fed is being asked to do multiple things that actively work against each other. Cool inflation, keep growth from stalling, protect the bond market from cracking. That's not a dual mandate. That's a juggling act on a moving treadmill. And while most people are glued to the headline decision, the real signals are showing up in places that don't make for catchy TV segments. Currency pressure, the long end of the yield curve, the behavior of gold and silver, and the part nobody wants to say out loud. What happens if the Fed is forced to choose the least bad outcome rather than the right one? Stay with me, because later I'm going to point out the one area where stress shows up first. Before it hits stocks, before it hits savings accounts, before the talking heads change their tone. It's not exciting, it's not flashy, but it's the closest thing we have to an early warning siren. Also, check the description when you're done here. I've left some bonus links, including access to a premium WhatsApp channel and channel memberships, so you can stay updated without relying on whether the algorithm feels generous that day. Here's how I think about Fed days. They're not about a single move, they're about direction. A quarter-point hike or cut can matter far less than the sentence explaining why. And right now, we're in a transition phase. You can hear it in the language, you can see it in how markets react not just to decisions, but to tone. We're drifting away from we're fighting inflation at all costs toward we're trying to keep the machine running. And this is where it gets uncomfortable. When a central bank starts talking like it's worried about growth while inflation is still sticky, that's not confidence. That's exhaustion. It's the policy equivalent of someone insisting they're fine while clearly not being fine. And once you recognize that fatigue, you can start to anticipate the next mistake. A seasoned macro voice I spoke with recently put it bluntly. The biggest policy errors weren't made last year or even the year before. They were made when emergency measures quietly became permanent, when rates stayed near zero for so long that people forgot what a real interest rate even looks like, when debt stopped being a temporary bridge and became the entire road. You don't have to agree with every part of that argument. I don't. But the core point is hard to dismiss. Cheap money became an addiction, and every attempt to normalize it has been tentative at best. Look at the pattern. Crisis hits, rates get slashed, markets cheer, then the hangover arrives. And instead of letting the pain clear the excess, the response is more of the same medicine. Each cycle leaves the system a little weaker. That's not ideology, that's incentives. So what happens if rates start coming down while inflation is still very real in everyday life? Not theoretical inflation. Grocery store inflation, rent inflation, insurance inflation. You get currency pressure, you get a reflexive move into hard assets, and you get the strange environment we're in now, where gold behaves like it's pricing in something bigger than today's headlines. Here's an uncomfortable truth. If you only watch stock indices and only read CPI prints, you're late. You're always late. Markets don't wait for permission. They reprice when they sense the rules are shifting. Over the past few weeks, that repricing has been showing up in metals in a way that's difficult to wave away as noise. Yes, metals are volatile. Yes, they can pull back. But when the regime is changing, the pullback isn't the story. The new floor is. The real question isn't whether gold is overbought on a daily chart. And the real question is whether we're still living in a world where the dollar is the unquestioned anchor, or whether we're drifting toward a world where the anchor is something else. Because even a small shift in what anchors, confidence changes price tags across the entire system. You can draw channels and trend lines all day. That matters for traders. But the bigger dynamic matters more. Why would global buyers want to hold a currency that has to be created in larger and larger quantities just to keep the system upright? Recent numbers show that interest costs on government debt are rising fast enough to become a political issue, not just an accounting one. And once interest costs become political, the pressure on central banks intensifies. Independence quietly turns into independence-ish. The market knows this. It anticipates it. That's how you get a weaker currency alongside a stronger gold price, even while the official narrative says everything is fine. It's not fine. It's just not officially not fine yet. One of the most dangerous misconceptions right now is the idea that policy is restrictive, simply because rates are higher than they were during emergency years. Restrictive compared to what? If your baseline was near zero for a decade, higher doesn't necessarily mean tight, especially if inflation is quietly eroding real returns. Real rates matter, and when real rates drift toward negative territory, you're effectively rewarding borrowing and punishing saving, just with more steps and better branding. That's why capital flows toward assets that can't be printed. Not because everyone suddenly becomes a gold evangelist, but because the math starts getting loud. Now here's where most people miss the plot. The next phase of this story isn't about gold at all. It's about bonds. The bond market is the spine of the financial system. It prices mortgages. It prices corporate debt. It tells you what future dollars are worth today. When that spine starts bending in unnatural ways, everything else has to compensate. So what happens if policymakers are trying to guide the short end lower while the long end refuses to cooperate? You get a tug of war, and tug of wars don't resolve politely. Short-term rates can be managed with speeches and guidance. Long-term confidence is governed by consequences. If investors start believing inflation will be tolerated because the debt load can't handle discipline, they demand higher yields. Higher yields mean higher debt service. Higher debt service means more pressure on policymakers to intervene. And when they do, the currency absorbs the cost. That loop is the story, not apocalypse, not collapse tomorrow morning, just mechanics. Which brings us to the question everyone asks when gold starts moving. Where's the top? What people really mean is, what's the big number? And there are two very different answers to that question. One is a trading number, a short-term zone where momentum cools and profits get taken. The other is a monetary number, a level that would make sense if gold is being repriced as a confidence anchor in a world drowning in debt. That number doesn't care about RSI, it cares about balance sheets. In a system with far more money and far more claims than decades ago, an anchor priced for the old world doesn't anchor the new one. It just decorates it. That's why central banks treat gold like insurance even while publicly dismissing its relevance. They don't buy it to trade. They buy it because it has no counterparty risk. Nobody has to perform for gold to be gold. That doesn't guarantee a straight line up. But it does explain why dips get bought in ways that surprise people, conditioned by the old spike and crash pattern. There's one last layer here, the traditional stock and bond portfolio. For decades, bonds were the safety valve. They cushioned drawdowns. If inflation risk and debt risk make long-duration bonds less reliable, that safety leg starts to wobble. And when that happens, the entire framework people rely on to feel financially secure starts to feel unstable. That's the environment we're stepping into. Quietly, gradually, and very few people are positioned for it. At the moment that safety net starts to feel unreliable, people instinctively search for something sturdier to grab onto. Not everyone reaches for the same thing, but when even a small slice of very large portfolios decides it needs a different anchor, it can have an outsized impact. Precious metals are a tiny pond compared to global stocks and global debt, so it doesn't take a tidal wave of money to move prices in a meaningful way. That's why, when you see gold accelerating, the useful question isn't, is this over? The better question is, who just decided they needed protection? And what did they see that hasn't made it into everyday conversation yet? Because by the time this becomes a casual topic over dinner, the low-friction part of the move is usually behind us. If you want the honest truth, nobody knows the short-term top. Anyone who claims they know the exact level is selling you confidence, not insight. Markets don't offer certainty, they offer probabilities, and sometimes not very clean ones. What I can say is that the kind of behavior we're seeing often shows up during repricing phases. That's when an asset moves higher to meet a new reality, then pauses and builds a base at levels that once sounded absurd. That's also why the obsession with, I'll only buy if it drops 10% can backfire. Sometimes that drop never arrives, and you end up waiting while the landscape quietly shifts without you. For long-term protection, a more realistic approach is staged buying. Smaller entries, planned ads, and enough patience to not panic when the screen turns red for a few days. This isn't about bragging rights. It's about building something that still makes sense when the market tries to shake you out of it. And yes, if you've navigated that well before, share your experience. People learn more from real examples than perfect theories. Gold, by the way, is the composed one in the room. Silver is the chaotic cousin. And that's where things get interesting. Silver has been behaving in a way that makes traders uncomfortable because it's suddenly reminding everyone that it's not just a shiny store of value. It's a working material, a supply chain input. And assets that live in both worlds, monetary and industrial, don't follow polite scripts. If you're wondering why silver can suddenly outrun gold, step back and look at the relationship between them. The gold to silver ratio acts like a mood indicator for stress. In calmer periods, the ratio tends to stay elevated as investors favor gold's stability. During inflationary bursts or speculative phases, silver often lags for a while and then snaps higher to catch up. That catch-up move can look wild on a daily chart, but it's often just the market correcting a long stretch of imbalance. What makes silver especially strange is how it's supplied. Most silver isn't mined because someone wakes up excited about silver. It's usually a byproduct of mining copper, lead, zinc, and other metals. That means even if silver prices double, supply doesn't automatically double. Production depends on the economics of entirely different markets. That's a real constraint. And building new mines isn't like ordering more inventory online. It takes years of exploration, permits, financing, and construction. Even when prices scream, "We need more," the metal doesn't magically appear next quarter. That delay is why tight markets can stay tight far longer than consensus expects. Now layer demand on top of that. Silver is woven into modern life in ways most people never notice. Tiny amounts per product, sure, but spread across millions of products. Solar panels, industrial electronics, data centers, advanced computing hardware, grid upgrades. If you've been watching the global push toward electrification and digital infrastructure, you've been watching demand for conductive materials quietly compound. This is why the simple argument that a recession automatically kills silver needs nuance. A slowdown can hit silver, absolutely, but it can also hit supply and trigger defensive stockpiling. And because silver is embedded inside larger products, manufacturers can't always substitute it away quickly. They might complain, they might redesign over time, but in the short run, they often pay up. The alternative is missed shipments, broken contracts, and angry customers. That's not a great trade-off. This is also why I watch mining stocks closely. They're a sentiment barometer. When metals rise and miners don't respond the way logic suggests, it often means investors don't trust the move. They assume it's temporary. They assume margins won't hold. Sometimes that skepticism is justified. Other times, it becomes the last bit of fuel before a rotation, when the market finally accepts that the cash flow math has changed. And when that rotation happens, it doesn't ease in gently, it sprints. So yes, silver can look like it's gone too far, too fast. But the bigger question is whether the market is compressing several years of adjustment into a short window. If that's the case, the first pullback isn't the end. It's the start of a new phase, where a base forms and the next leg gets built. That's why behavior matters more than emotion. Does silver get smashed and stay smashed, or does it get hit and then quietly bought back? A persistent bid underneath the market tells you this is repricing, not just a trade. Before going further, let's address an argument that refuses to die. Gold can't be money because there isn't enough of it. That sounds clever until you think about it for 10 seconds. Money isn't about quantity, it's about price. Scarcity doesn't break a system, it raises unit value. That's how markets clear. You can run a massive economy on a small anchor if the price adjusts accordingly. The real obstacle isn't physics, it's politics. A hard anchor limits how much spending can be pushed through without consequences. Discipline always has critics, especially when it shows up with a bill attached. This is where the narrative starts to get messy. People whisper about leadership changes at central banks and fantasize about a tougher figure riding in to restore order. I'll be blunt, betting on one person to reverse decades of structural incentives is wishful thinking. Personalities matter, but math matters more. In fact, there's a strong case that the next leadership team could face even greater pressure to be accommodative. Slower growth plus rising debt service tends to produce demands for relief. And relief usually means lower rates, easier liquidity, and bigger balance sheets. If you're waiting for a hero, bring a book. You might be waiting a while. Now consider something you may have noticed. Why do yields sometimes feel too low given the scale of debt and inflation risk? Part of that is structural. Massive institutions are required to hold bonds. Regulations, mandates, collateral needs. There's also decades of conditioning that government bonds are the ultimate safe asset. But tradition isn't armor. If confidence cracks, mandates don't protect you from mark-to-market losses. That's why the long end of the curve matters so much. It's the battlefield. If long-term rates rise quickly enough, policymakers feel compelled to respond. Historically, the easiest response is some form of yield suppression. Purchases, guidance, new tools, old tools with new names that can calm markets temporarily. But it sends a clear signal. The system needs help. And when the system needs help, the currency pays the bill. Which brings us to the practical question everyone asks. If metals are moving, what do I actually do? First, stop thinking like a day trader if you're not one. Most people don't need perfect entries. They need a plan that survives stress. The market's job is to toy with your emotions. Your job is to not let it. Second, think in terms of allocation, not extremes. Not all in, not all out. How much of your net worth do you want in assets designed to protect purchasing power? That's personal. But it's a decision you're better off making calmly than under headline pressure. Finally, let's zoom back in on the industrial angle, because this is where narratives flip. A slowdown in one economy doesn't erase global demand, especially when currency moves make commodities cheaper elsewhere. Substitution takes time. Inventories matter. And fear of disruption changes behavior. Hoarding isn't rational on paper, but it's very real in practice. You see it across supply chains, not just metals. It's the same instinct that makes people buy extra batteries before a storm. It's not about price, it's about availability. You may hear headlines about export restrictions or resource nationalism. Policies change and headlines exaggerate, but the underlying trend is real. Countries are becoming more protective of strategic resources. That doesn't guarantee shortages tomorrow, but it does change how markets think about risk. And when risk gets repriced, it rarely does so gently. There's a bigger backdrop that doesn't get enough attention, and it's this quiet shift toward control. Governments increasingly want influence over strategic inputs. They don't love the idea of shipping out critical materials cheaply, only to buy back finished products at a premium later. So even if you dismiss any single headline as noise, the direction of travel matters. Supply chains are being politicized, not hypothetically, but in practice. And if silver is starting to be treated as strategically important rather than just another commodity, that should make you pause. It raises an uncomfortable question about priorities. In a crunch, do governments favor uninterrupted industrial access to metals, or do they care about investors freely accumulating them? That's not a conspiracy question, it's a policy question. And it's one worth thinking about before the rules change quietly in the background. Now, let's talk about market behavior without disappearing into chart jargon. When silver starts moving sharply higher, it tends to attract two very different crowds. You get momentum chasers who buy because price is going up, and you get skeptics who sit on their hands because they're convinced it has to crash. Ironically, that tension can keep a rally alive longer than logic suggests. The skeptics don't disappear, they watch. And if the dip they're waiting for never really comes, they often end up buying higher out of frustration. That forced participation can extend moves well beyond what feels comfortable. Of course, parabolic moves always cool off. Gravity never gets repealed. The real question isn't whether silver pauses, it's where it settles when it does. That's why I'm not a fan of the immediate, this is the top narrative when the move is tied to a broader repricing theme. True mania has a very specific feel. Everyone is euphoric. Everyone is confident. Everyone is telling their friends it's easy money. Do you see that in metals right now? I don't. What I see is hesitation, curiosity mixed with doubt. I see people asking if this is real. I see mining stocks sometimes lagging even as metal prices rise, which tells you the crowd doesn't fully believe it yet. And disbelief is not what tops are made of. Disbelief is fuel. Now, let me offer the skeptical counterpoint, because balance matters. Some macro voices treat every rally in gold or silver as proof that the entire monetary system is on the brink of imminent collapse. I think that's overstated. Systems can limp along for a very long time. Policymakers can patch holes, new tools can be invented, the world can muddle through far longer than clean theories predict. So this isn't about panic, it's about positioning. Even if you believe the system survives, the way it survives may involve more liquidity, more debt, and more currency dilution than most people are prepared for. You don't need an apocalypse to justify a hedge, you just need math. This is where stocks enter the conversation, because many people are confused. If equities are still holding up, why bother with gold at all? In normal environments, stocks can act as a partial inflation hedge because companies raise prices. But that logic breaks down when valuations are stretched, margins compress, or the cost of capital rises. Here's a key piece of context that often gets overlooked. Over the past few decades, equity returns haven't just come from growth. They've been amplified by falling interest rates and expanding valuation multiples. If that tailwind turns into a headwind, stocks can struggle even if inflation doesn't disappear. That's when the stocks will save me assumption gets tested. Add another wrinkle. If a recession arrives while inflation remains uncomfortable, you end up in a nasty environment. Bonds don't protect you the way people expect, and stocks can't lean on easy money. That's when portfolios start looking for something that behaves differently, not because people suddenly fall in love with metals, but because diversification stops being a buzzword and starts being a survival skill. Bear markets have a way of reminding people why uncorrelated assets exist. Crypto tends to trigger strong reactions here, so let me tread carefully. On one extreme, you have critics who dismiss the entire space as nonsense. On the other, believers who treat it like destiny. Neither extreme is very helpful. Digital assets are a broad technology category with wildly different quality levels. Some projects will fail, some may endure. The real question for risk management isn't who wins online arguments, it's how these assets behave under stress. Much of the crypto market has never lived through a full-scale liquidity event while also being deeply embedded as collateral. We're still learning. And historically, when forced deleveraging hits, The assets that feel most optional tend to be sold first. That doesn't mean crypto has no role. It does mean it's reasonable to ask whether gold and silver serve as the non-optional hedge in a portfolio. An interesting bridge between these worlds is tokenized gold. The idea is straightforward. Real metal is stored securely, ownership is represented digitally, and transfers become easier. In theory, if it's fully backed, audited, and not rehypothecated, it can make gold more usable. The problem is temptation. Finance loves leverage. Once paper claims exist, there's always pressure to issue more claims than there is metal. That's how you end up with a system where gold is mostly a pricing reference, not a delivery asset. And that distinction matters, because when confidence cracks and people ask for delivery, real metal and paper, promises stop behaving the same way. So if you're looking at tokenized structures, the real question isn't whether it uses a blockchain. It's whether it's one-to-one or fractional, and whether the rules actually hold when tested. Add to that the reality of compliance. Legitimate systems involve identity checks and regulations. That doesn't erase their usefulness, but it does mean they're tools, not escape hatches. There's a broader shift happening here that's easy to miss. Central bank digital currency discussions, stablecoins, tokenization, all of it points toward a world of more programmable money. Whether that excites you or worries you, it's coming in some form. And ironically, the more programmable fiat becomes, the more attractive outside the system assets can feel to people who value optionality. That doesn't mean gold replaces everything. It means the menu of hedges gets wider. Which brings us back to portfolio construction. If this trend continues, the biggest risk may be concentration. If you're all in on one story, only tech stocks, only long-duration bonds, only crypto, only cash, you're betting that one narrative survives unscathed. The next era may not be kind to one-story portfolios. The resilient approach is boring by design. A mix of real assets, reasonable cash, quality equities, and hedges that don't all fail at the same time. Boring doesn't trend on social media, but it tends to work. I also want to mention something specific to this channel. We produce members-only content that goes deeper with more data and more charts, handled by a separate research team. If that level of detail helps you think better, the join link is in the description. Before we wrap this up, there's one part most people skip, and it's the most important part. How you behave when screens flash red. If you hold metals as insurance, you have to expect scary headlines. You have to expect sharp pullbacks that feel personal. That's the cost of owning something that isn't someone else's liability. But those moments are also tests. When prices fall, ask yourself what actually changed. Did policy reverse, or did sentiment swing? Did physical demand vanish, or did paper traders panic? When you ask those questions consistently, you stop reacting and start evaluating. Here's the cliffhanger to leave you with. The next big clue may not be a dramatic price move at all. It might be a quiet rule change, a technical adjustment in liquidity, or a temporary measure introduced with little fanfare. Big regime shifts often happen that way. No trumpet, no alarm, just plumbing changes that alter incentives. Temporary policies have a habit of becoming permanent the moment they appear to work. So where does that leave us on a Fed decision day? With a simple reality. If policymakers lean easier while inflation remains uncomfortable, currency risk rises. If currency risk rises, hard assets stay supported. If long-term yields rise anyway, the pressure loop tightens. And when that loop tightens, the next few quarters can look very different from the last few years. Today isn't the end of the story. It's a page turn. Watch the reaction after the press conference, not just the headline. Watch the dollar. Watch the long bond. Watch whether gold and silver hold gains or get immediately pushed down. The why matters more than the what. And remember this, price moves are signals, not prophecies. Rising gold doesn't guarantee anything. Falling stocks don't guarantee anything. The goal isn't to predict every tick. It's to build a financial life that doesn't fall apart because one institution changes tone. Drop your thoughts below, tell me when you're watching, and let me know whether you think this is a short-term surge or the start of a longer repricing. And as always, this is education and discussion, not personal financial advice. Do your own homework, get professional guidance if you need it, and make decisions you can live with when the market gets loud.